Welcome to this session on understanding debt investment banking. I have designed this specifically for people who are new to this concept, whether you come from a non finance background or you are early in your finance career and still figuring out what debt IB actually means. Let me be upfront, this is not a motivational talk. I am not here to sell you a dream. I am here to help you understand what this function is, what professionals in this space actually do, and what it genuinely takes to build a career here. So let us get into it with a clear and structured approach. Before we begin, let me walk you through what we will cover today. We have 8 sections. We start with the most basic question: what does debt investment banking even mean? Then we look at what the team actually does, how a typical day looks, whether someone from a non finance background can enter this space, what kind of growth is realistic, what skills you need, and finally, we will bust some common misconceptions. By the end of this session, you should have a clear and honest picture of this career path. Let us begin. Let us start with the most fundamental question: what does this term debt investment banking actually mean? I want to build this from the ground up so that everyone in the room is on the same page before we go deeper. When most people hear investment banking, they think of equity deals, IPOs, mergers, acquisitions, buyouts. That is only one side of the picture. On the other side sits debt investment banking. This is the function of helping institutions raise borrowed capital. Now, the key word here is borrowed. Unlike equity, where you sell ownership and never have to return the money, debt must be repaid with interest within a defined timeline under specific conditions. The debt IB team decides which instrument to use, which lender to approach, what rate to negotiate, and what terms to accept. Think of it this way: when a family wants to renovate their house, they choose between a home loan, a personal loan, or breaking a fixed deposit. Each option has different costs and consequences. Institutions face the same choice, but at a much larger scale and with far more complexity. The debt IB team is the one making those choices strategically. Now, let me show you how equity IB and debt IB differ side by side. On the left, you have equity IB. This is about selling ownership. IPOs, FPOs, QIPs, private placements. The capital raised does not need to be returned. Investors bear the risk, and their returns depend on how the company performs. Deal frequency tends to be lower. You do not see a company doing an IPO every quarter. On the right, you have debt IB. Here, the institution borrows money under defined terms. It uses instruments like term loans, NCDs, commercial papers, ECBs, and securitization structures. This capital must be repaid with interest. And here is what most people miss: the volume and frequency of activity in debt IB is significantly higher. An NBFC might raise debt every single month. Every quarter, there are new facilities, new maturities, new negotiations. So while equity gets the headlines, debt is what keeps institutions running on a daily basis. Neither is better than the other. They are fundamentally different domains requiring different expertise. So, where do debt IB professionals actually work? Let me make this tangible. The most active space is NBFCs, non banking financial companies. Every time you see an NBFC giving out vehicle loans, personal loans, or business loans, remember that NBFC first had to borrow that money from somewhere. The team that arranges that borrowing is the debt IB or Treasury team. Banks also have debt capital markets teams. They raise money through bonds, tier 2 instruments, and interbank borrowing. Large corporates raise debt for expansion, working capital, or to refinance old obligations. Housing finance companies borrow to fund the home loans they give out. Even AIFs and infrastructure entities rely on structured debt. The point is, debt IB professionals are present across the financial ecosystem. This is not a niche function sitting in one type of organization. It is everywhere capital is needed. Now, let me explain why debt capital is not just useful but absolutely critical. No institution of meaningful size can operate purely on equity. The economics simply do not work. Financial institutions, in particular, borrow at one rate and lend at a higher rate. The spread between these two is how they earn. If they cannot borrow efficiently, they cannot lend. If they cannot lend, they have no revenue. It is that direct. Beyond that, debt is a more cost efficient form of capital. Equity investors expect higher returns because they bear more risk. Debt has a defined cost, and that cost is almost always lower than what equity investors demand. Regulators also require institutions to maintain specific capital structures. You cannot just have equity or just have debt. You need both in the right proportion. And diversification of funding sources is critical. Relying on one lender or one instrument creates fragility. So, when I say the debt IB function is existential for financial institutions, I mean it literally. Without this function working well, the institution faces operational risk, regulatory risk, and potentially survival risk. Now that you understand what debt IB is and why it matters, let us look at what the team actually does. This is where it gets practical. I want you to understand the real activities, not theory, but what happens on the ground every week. Let us start with the core capital raising activities. The most common one is raising term loans from banks. This is not about filling a loan application. The team prepares detailed financial projections, presents the institution's credit profile, negotiates the interest rate, argues for favorable covenants, and ensures the loan structure matches the institution's cash flow pattern. Then there is commercial paper. These are short term instruments, typically 90 to 365 days, that institutions sell to mutual funds and banks. Think of them as short term IOUs. The institution needs a CP program and a valid credit rating to issue these NCDs. Non convertible debentures are medium to long term instruments. Here, the team has to decide the coupon rate, the tenure, what security to offer, and who to sell them to. And then there are ECBs, external commercial borrowings, where the money comes from overseas lenders. This brings in an entirely different set of rules: RBI guidelines on end use, cost ceilings, mandatory hedging. Each of these instruments is a world in itself, and the debt IB team needs to understand all of them. Now, let me cover two transaction types that are less understood but extremely important: direct assignment and PTC transactions. In a direct assignment, the institution sells a pool of loans from its own books to another institution, typically a bank. The asset moves, the risk moves, and the institution frees up capital to lend more. In a PTC transaction pass-through certificate, the institution packages a pool of loans into securities and sells those securities to investors. This is securitization. Both of these serve a critical purpose. They help institutions manage their balance sheet, improve their capital adequacy ratios, and address asset liability mismatches. But executing these transactions is complex. You have to select the right pool of loans, get the pool rated by a credit rating agency, prepare extensive legal documentation, negotiate the price with buyers, and coordinate across legal compliance. operations, and the counterparty's team. This is advanced structuring work, and it has a direct and measurable impact on the institution's financial position. Now, let me talk about the relationship and data side of the role, because debt IB is not just about structuring, it is equally about relationships and communication. The team maintains ongoing relationships with banks, mutual funds, insurance companies, and other institutional lenders. You are not just calling them when you need money. You are regularly sharing updates, presenting financial performance, and keeping them informed so that when you do need a facility, the conversation starts from a position of trust and credibility. Rating agency interactions are critical. Agencies like CRISIL, ICRA, and India Ratings review your institution's credit rating periodically. A downgrade, even by one notch, can increase your borrowing cost across every facility. So the team prepares extensively for these reviews, presenting data packs with financial statements, portfolio quality data, collection efficiency numbers, and forward projections. Term sheet negotiation is where your analytical ability meets commercial judgment. Every clause, every covenant, every pricing condition, every security requirement has real financial consequences. And covenant monitoring does not stop after the deal closes. You have to track compliance with agreed ratios and reporting thresholds throughout the life of each facility. This is the section people are most curious about. What does someone in debt IB actually do from morning to evening? Let me give you an honest and practical picture. No glamour, no exaggeration, just what the day really looks like. Here is a realistic breakdown of a working day. You start around 8 to 30 by reviewing overnight market rates because interest rates and liquidity conditions can shift while you were asleep. You check your CP and NCD maturity schedule to see if anything is coming due. You scan any new RBI circulars that might affect your borrowing strategy. By 9:30, you are on calls with lenders discussing pricing on a new facility, sharing data they have requested, or following up on a sanction that is in progress. Between 11 and 12:30, you are deep in numbers, updating cash flow forecasts, reviewing the ALM position, coordinating with the collections team to get inflow data. After lunch, you are preparing lender MIS reports, compiling data packs for upcoming meetings, and sitting in internal review meetings. The afternoon is for heavier work, negotiating pricing on new facilities, reviewing term sheets line by line with the legal team, coordinating documentation. Between 4 and 5:30, you are monitoring the liquidity position, making sure disbursement instructions are processed, and escalating any funding gaps to senior management. And you close the day by updating your transaction trackers and preparing your priorities for tomorrow. During month end or quarter end, multiply the intensity of all of this by 2 or 3 because reporting deadlines, maturity schedules, and deal closures all converge at the same time. Let me be direct about the pressure involved. If you miss a maturity payment, even by one day, it can trigger a default event. That default shows up in rating agency records, shakes lender confidence, and can take months to recover from. If a number in your data pack is wrong and a lender catches it, your credibility takes a hit that can stall a transaction you have been working on for weeks. You are managing multiple transactions simultaneously, each at a different stage, each with a different counterparty, each with its own deadline, and the margin for error is thin, especially during periods when liquidity in the banking system is tight. I am not telling you this to scare you. I am telling you because this is exactly what makes the expertise valuable. Institutions depend on people who can handle this pressure consistently and accurately. If you can do that, you become very difficult to replace. Now, let me address a question I get asked frequently. Can someone who does not come from a finance background enter this field? The short answer is yes. But the honest answer has important conditions attached to it. Let me walk you through what those conditions are. First, let us talk about mindset. You need a genuine willingness to learn financial concepts from scratch, and I mean from scratch. Not just picking up terminology, but understanding the logic behind it. You need to be comfortable with numbers and structured data, even if you have never had formal training. You need patience. This is not a field where you can cram for 2 weeks and be ready. The learning is cumulative and it takes months to build a solid foundation. And you need the ability to handle ambiguity because in the early stages, a lot of your learning will come from observing how experienced professionals operate, and things will not always make sense immediately. Now, on the right side, these are the foundational concepts you must master. There is no shortcut around these. Time value of money, how interest rates actually work, how to read a balance sheet, P&L, and cash flow statement. You need to understand credit risk, what makes a borrower creditworthy and what does not. You need to know the regulatory basics, RBI norms for NBFCs, capital adequacy requirements, ALM principles, and you need instrument level knowledge. What is an NCD? How does a CP work? What is the difference between a term loan and a working capital facility? Structured programs and mentorship will get you there much faster than self study alone. Let me give you some realistic transition pathways. If you are currently in operations, say loan processing, disbursement, or collections, you already understand how the products work. You can build on that understanding to learn how those products are funded. Internal rotations into treasury functions are a natural path. If you are in audit or compliance, you understand regulatory frameworks and financial data at a deep level. That foundation translates well into capital raising roles where you need to present data to lenders and ensure regulatory compliance. If you are in corporate finance budgeting, MIS, financial planning, your analytical skills are directly transferable to debt IB context. And if you are a fresh CA or MBA graduate, you have the theoretical foundation, but you need practical exposure through internships or associate level roles in Treasury or DCM teams. The common thread across all these pathways is this: demonstrated analytical ability, a genuine interest in how markets work, and a willingness to invest serious time in structured capability building. There is no shortcut, but for those willing to do the work, the path is clear. Assuming someone enters this field and puts in the work, what does the career trajectory actually look like? Let me walk you through this honestly. No inflated titles, no exaggerated timelines. Just what the progression realistically involves in terms of capability and responsibility. At the analyst or associate level, you are primarily learning. You are assembling data, preparing MIS reports, coordinating with lenders on their information requirements, and understanding how different instruments work. Your job is to support the senior team and absorb as much as you can. At the senior associate or manager level, you start owning things. You execute deals with less supervision. You manage lender relationships directly. You interact with rating agencies and start building your own credibility in the market. At the vice president or senior manager level, you are structuring complex transactions. You are making judgment calls on pricing, risk, and deal structure. You are managing the team's output and driving the institution's pricing strategy. And at the director or head of treasury level, you are setting the institution's borrowing strategy. You are managing the most senior lender relationships. You are presenting to the board. The decisions you make directly affect the institution's cost of capital, its regulatory standing, and its ability to grow. Each level demands more judgment, more autonomy, and more accountability. The timelines vary by individual and institution, but the path is well defined and the progression is capability driven. Let me explain why debt expertise has long term staying power. Institutions will always need to borrow. That is not changing with technology, with AI, with any market cycle. As economies grow, credit markets grow with them. The volume of debt transactions goes up over time, not down. Regulatory complexity is also increasing, which means professionals who understand both structuring and regulation become more valuable with each passing year, not less. Here is something else that makes this feel distinctive. You get exposure to senior management early. Borrowing decisions are board level decisions. The CFO, the MD, and the board audit committee are directly involved. That means even at a mid career stage, you are regularly presenting to and interacting with the most senior people in the organization. That kind of exposure is rare in most other functions. And the skills you build analytical rigor, negotiation, risk assessment, structured communication these are transferable. They make you relevant not just within one institution but across NBFCs, banks, corporates, AIFs, and even consulting firms. Now, let us talk about what it actually takes to succeed in this field. I am not talking about qualifications on your resume. I am talking about capabilities that you develop through practice, through experience, and through years of doing the work. Let me go through each one. Analytical thinking. This is not about knowing Excel formulas. It is about looking at a set of cash flows and understanding what they mean for the institution's repayment capacity. It builds through repeatedly working with financial data and seeing how numbers connect to real business decisions. Negotiation this develops through first observing and then participating in lender discussions. Good negotiation in debt IB is not about being aggressive. It is about understanding what both sides need and finding terms that work. Risk awareness, this comes from experience, especially from seeing what happens when things go wrong. A maturity mismatch, a rating downgrade, a sudden liquidity crunch. Each of these teaches you something that no textbook can. Structured communication, you will constantly be presenting complex information to people with different levels of knowledge. A lender, a rating agency, analyst, your own CFO, each needs the information packaged differently. Financial modeling, this is a technical skill that gets better with practice. You are building projections that must reflect realistic assumptions, not optimistic fantasies. And market awareness, this develops by reading, tracking, and discussing interest rate movements, RBI policies, banking system, liquidity, and what your peers in the industry are doing. None of these skills arrive overnight. They develop over years of consistent, deliberate practice. Before we close, let me address four misconceptions that I hear regularly and that actively discourage talented people from considering this career. First, it is just borrowing money. No. Deciding how much to borrow, from whom, at what rate, for what tenure, with what security, under what covenants, that is a complex strategic exercise involving multiple instruments, multiple counterparties, and multiple regulatory frameworks. It is nothing like filling a loan application. Second, it is a back office function. The debt IB team meets lenders face to face. It presents to rating agencies. It negotiates directly with counterparties. This is a front facing deal execution role with real commercial impact. There is nothing back office about it. Third, it is basically accounting. Yes, you must understand accounting, but the role is about using financial data to make decisions about pricing, about risk, about structure. You are not recording journal entries. You are using the numbers to negotiate, to structure, and to advise. Fourth, it is low visibility work. Think about these funding decisions. Go to the board. The CFO depends on this team for the institution's capital plan. Rating agency outcomes affect the entire organization. Ask yourself, how many other functions at a mid level give you this kind of direct access to the CFO and MD? The answer in most institutions is very few. Let me close with five takeaways. 1. Debt investment banking is about capital structuring and institutional stability. It is a strategic function, not an administrative one. 2. It requires structured capability building, analytical skills, market understanding, and communication, all developed over time through practice, not shortcuts. 3. This field offers genuine long term relevance. As long as institutions borrow, this expertise will be in demand. 4. Entry is possible from non finance backgrounds, but only through deliberate, structured learning. Casual exploration will not get you there. 5. Clarity about what the role demands is essential before you decide to enter. Understanding the function honestly is the first and most important step. Thank you for your time. I hope this session gave you a clearer and more honest picture of what debt investment banking actually involves. I'm happy to take your questions now.